Hello, fellow Robo Capitals. Hope you're well. I'm back with my good buddy Brent Johnson. Dude, CPI just came out. What are your thoughts?
Well, the fact that they were pushing to release it early, you kind of had to expect it to come in light, right? I don't think he would have. I don't think he would have been pushing for it to come out and do a special, send the BLS workers back to work for a few days if it was going to be hawkish.
Right.
To me, it's just a continuation of what we've seen, is that inflation is not crashing, but it's also not going up. It's kind of steady. It's up a little, down a little bit. Sometimes you'll see one that's a little, it meets or it exceeds just a tiny bit, but then the others miss. But to me, it kind of reminds me of something that I used to hate. I used to hate it when people would say, I think we're going to have stagflation, because I thought it was a complete cop out. You're just not willing to make a call. But I actually think that's kind of what we have. I think some things are going to some prices are going to remain sticky and probably aren't going to go down that much, and probably even go up in some cases, but other prices are going to come down. And I think that is the challenge that the Fed is going to have, is how do you manage a stagflationary environment when your policies help one side but hurt the other? And I don't think it's going to be easy for them.
Yeah. And that's an interesting definition too, because most people, I think, when they hear the word stagflation, they don't just think, well, inflation is slightly higher than the Fed's target. They think inflation accelerating and getting completely out of control. So it's going from, as to say, the CPI is going from 3% to 5% to 9% to 15%. And this is usually what they think of when they think of stagflation. And they think of that combined with high levels of unemployment. But I think what you're saying is the economy is going to be weak, labor market is deteriorating, but yet the CPI, if you want to use that as a proxy, is staying slightly above the Fed's target.
Right. Exactly. And so it's hard for them to cut aggressively if inflation is sticky. It doesn't mean it's going up. It just means it's not falling a lot, right? It doesn't mean they can't cut. It doesn't mean they can't take real rates negative. It just makes it more challenging, especially considering what we've had over the last 2-3 years with kind of the social outrage at the inflation that showed up in 2021 and 2022.
Yeah. So do you think for the Fed to really drop, they'd need a much more significant deterioration in the labor market? And how does that happen if we're not getting any data?
Well, that's okay. That's the thing. This makes it harder for the Fed. I mean, theoretically, I'm sure they have their. I mean, how many thousands of PhDs do they have employed? Hopefully, they can calculate this stuff on their own. They don't necessarily have to wait. Right. They don't necessarily have to rely on everything that the rest of the government calculates.
Yeah.
But it does make it not only makes their job harder, it makes my job harder. It makes other people's jobs harder, because you're kind of in limbo. And if things were trending hard in one way, it wouldn't necessarily be as hard as the fact that everything's a little bit in limbo, right? And so it puts uncertainty on top of uncertainty. And I don't like uncertainty. I don't think markets like uncertainty, but the trend is higher. And until we get some kind of a catalyst or something happens that shakes that trend, I suppose no news is good news.
Yeah, right.
But the flip side of that, is let's just fast forward in time 3 weeks, and let's pretend now the government opens back up. And so not only do we get all of the October data that is now released, but we also get the November data. You have a potential,
like a deluge.
You have a potential of a deluge of either good or bad. And I listen, I don't know which way, but it has the potential to be a catalyst mid-November or December, whenever this thing gets wound down, right? It's not a guarantee. It just says it sets up an opportunity for some volatility, especially when volatility's been, in my opinion, at least, irrationally low.
Yeah, I didn't know how that works. I didn't know if, let's just say they reopen tomorrow. I didn't know if the data comes out like the very next day, or if it takes them 2 weeks to kind of gather it together.
My guess, I don't really know. I should look that up. I actually don't know the answer. My guess is that they don't it would take them a week or two because they're going to have to calculate it, right? It doesn't calculate itself and then they release it. They have people at work that do the work to calculate it. So my guess is that when the government reopens, let's say it reopens on November 8th, they will say, November 15th, we're going to release . I mean, my guess is that's what they'll do. I don't know for sure, but my guess is that's how they'll do it.
Yeah, that would make sense. I mean, I think if I had to guess, I usually lean a little bearish just because fundamentally I think the economy is really weak. But I think I'd probably be a little bit more. So if I had to make a bet, I'd probably say there's a further deterioration in the labor market due to ADP and then due to what we're seeing with all of the subprime lenders just completely blowing up and, fraudulent collateral and a lot of that with the subprime auto. And then also I think real-time rent growth it's at its lowest levels, or if it might even be flat. And so that's another kind of indicator for me that says, the average Joe and Jane, especially at the lower end of the totem pole, the economic totem pole, isn't doing well. And that's usually kind of the first signs that you see, or a confirmation sign for the labor market getting worse.
Yeah, no, I tend to think that things are getting softer, right? And this is probably a good time for me to say this because I know that there's going to be people watching this and say, Brent, you were super bearish in Q3 and you were wrong. And that's true.
Were you bearish on the economy or bearish on the market?
No, I was bearish on the market.
Those two separate things.
Right. But I thought everything was set up for what I thought we were going to have was a pretty healthy correction in Q3 and then a melt up into the end of the year. And we just completely skipped the correction and melted straight up into now, right? Yeah. And so I think in this business, you always have to understand that you can be wrong. And when you are wrong, I think you just have to admit it and accept it. And then I think you don't have to spend time dwelling on the fact that you were wrong, but you have to kind of figure out, what did I miss, right? Mm-hmm. And I think probably what I missed was things are not that bad right now. And you could actually argue things are good. My mistake was trying to put a time frame on how it could get badly really quickly. So in other words, if you look at several different indicators, they're not that bad, right? They're not great, but they're not that bad. Markets are trending up and to the right. The Fed is in an easing cycle, whether you think they should or you shouldn't think they shouldn't. They're cutting rates. It's only a matter of how aggressively at this point. There's not a clear catalyst on the horizon for fund flows to reverse. And so as the effects of passive, it just continues until it does reverse, right?
Yeah.
And so my mistake was thinking that we would have an event in Q3 that would cause those fund flows to stop, whether it was earnings, whether it was geopolitical, whether it was data coming out. And because of the concentration of, let's call it a handful of very large cap technology names that are driving all of the growth in the market, if just a few of those break down, it can drag the whole market with it.
Oh yeah.
So this is kind of an example of being too clever by half, right? You have this knowledge and you know how quickly it can get. The point is, I know that it can get bad very quickly. And because I know it can get bad very quickly, it keeps me from fully embracing the upside. Now, we're still long assets. I'm not saying we're completely short on everything, but I've all of this. So we did really well in Q1 and early Q2. And all of the signals that helped me be ready for late Q1 and Q2, I saw again in August, late July into late August. And so I thought we would play out similarly. I didn't think we would go all the way back down to the lows of April, but I thought we would get a similar price action. But it just didn't happen, right? And so now I'm sitting there looking at things, and I think in this type of a market, you kind of just need to ride it with protection, right?
Yeah.
So it's really hard to short a bull market. A lot of people say it's safer to let the market break and shoot it in the back on the way down, right? And in hindsight, that's probably right. But I do think that this market, while it can easily go higher, I do think there's a lot more risk out there than the average person is aware of. Now, if of course, if you go on Twitter and different blog posts, you can find all kinds of bearish content, and that stuff sells pretty well. It's really to me, it's a fascinating time because I can make an argument for this melt up to continue. I absolutely can, but I can also make a very good argument for why it could end tomorrow, right? And trying to balance those two can give you a little bit of what's that word? Cognitive dissonance, holding these two competing theories in your head at the same time without going crazy.
Yeah, you know what it's like? I just watched an old rewind of Top Gear, an episode, and it was the Bolivia special where they're riding on that death road in Bolivia.
Oh, yeah.
I'm sure you've seen YouTube videos of that. And so if you're driving on this death road, if you look to the left, like you're good. Like, what are you talking about? Bear market, drop in the S&P 500? No way. We're smooth sailing. Look, there's a big cliff right there. We got a gravel road. It's no problem. But then if you look out the right-hand window, you're like, holy shit.
Yeah. No, that's a good example.
Drop. And that's pretty much what we're dealing with in the markets right now.
And that's the thing is, if it wasn't, and it's funny because again, the curse of knowledge, right? Like Mike Green is a genius, right? He figured out this whole passive thing, and like his thinking has greatly influenced my view of the market.
Yeah, for sure.
And so I completely understand why markets can push higher. And to be honest, his work like really affected my overall framework as well, because I think as flows come into the US, it just pushes prices higher. But also knowing how quickly that can change and how quickly things can drop as a result of it, it's it keeps you from just enjoying the ride, right? In other words, ignorance in this type of a market, ignorance really is bliss, right? Until the drop comes. But if you take up either a 20-year chart or even just a 10-year chart of the S&P 500, it's a pretty amazing chart because you get these very consistently 18 to 36 month up and to the right moves. Mm-hmm. And then you get these terrifying drawdowns that last 2 to 6 months. Right. And then you start that 18 to 36 month drive again, and then you get the terrifying drawdown. And knowing when that terrifying drawdown is going to come, I mean, that's the trick, right? That's the trick. And I think there's a lot of people who are conditioned to the belief that you just buy every dip because so far that has worked.
Yeah.
If and when it ever doesn't work, or if and when the powers that be are not able to quote unquote save it as quickly as they have in the past, then the whole world changes, right? So having those two pieces of knowledge, it's a bit of a curse, right?
Yeah.
But it may save you. It's a bit of a curse in the short term, but I believe, we'll see. I believe it'll help save you in the end.
Yeah. Yeah. I think that makes a lot of sense. And, it's going back to what we were saying earlier, there is a complete bifurcation between the stock market and the economy. And we're still just intuitively, we believe they're somehow connected. But what you have to set back and realize is that they're not connected. In fact, often there's an inverse correlation. And the economy right now doesn't matter until it does. And the trick is, when does the economy matter? And I can assure you, if we had the unemployment rate spiking to 6%, or if we had the CPI going down, if we had more negative non-farm payrolls, if we get them, then that's going to impact the market negatively. And then people say, well, the Fed drops, right? Well, the Fed dropped in 2008. It didn't do anything. The Fed can drop, and the overwhelming cross current can be the economy that can overwhelm any bullish narrative. It's just a matter of when does that, or if that happens. Because right now, I think the reason, if you just told me, hey, George, why was Brent wrong in Q3? I'd just say narrative. It's just, it's narrative. It's narrative. And we haven't got the unemployment rate up to the level where passive goes from a net inflow to a net outflow.
Yeah. I mean, that passive is the driver. I mean, it really is, right?
Yeah.
As long as the flows are there, we're going higher. Once they stop. And this is the other thing. I think a lot of people are looking for some big individual event or some negative catalyst that will now cause this cascading fall lower. And that I'm not saying that can't happen. But really, when you think about passive driving everything, you don't really need a negative catalyst. You just need the new flows to stop showing up.
It could be demographics.
Yeah, exactly. Right. It could just be that there's no new money to put to work. Right. So there's no new flows. And then the first person that sells eventually, for whatever reason, maybe in a totally innocuous reason, that starts the flows the other way.
The cascade, right?
That starts the cascade, right?
Yeah, I don't know if I told you this, but when we were in St. Bart's, I had like a 2-hour lunch with Mike Green and the other guy that doesn't like his name to be mentioned. I call him, I call him Steve.
I know, yeah.
But we had about a 2-hour, maybe even a longer conversation, and this was one of the main topics. And we were asking Mike Green, do you have any models as to, what would trigger this? And he said he does have some, he's modeled it out. And based on his calculations, it's the unemployment rate getting to about 5.5 or 6%. Okay. And but let's also remember that, if you're super bullish on AI as a technology, we'll set aside the stocks. I mean, AI as a technology could take the unemployment rate up to 5.5% in and of itself. But based on Mike's models, that's where he says kind of the line in the sand is between the net inflows turning to net outflows, right around 5.5 or 6%.
Yeah. I mean, that makes sense, right? Because at that point, you're going to have negative, the flows are going to be decidedly negative.
Yeah. There's not enough paycheck money just indiscriminately going into the S&P 500 index fund.
Right. Yep.
Yeah. Exactly. So Brent, what do you think is going on with gold? I mean, it goes parabolic. And tell me what your thoughts are right now on gold and the miners. And then I want to tell you a story about a trade I made where I made a lot of money, but I didn't do it the right way. I could have done it a lot better. And once I got out of the trade, I heard your voice in the back of my head saying you should have done this. And I'm like, dang, Brent has said that so many times. Why didn't I remember, him saying this when I was actually putting on the trades? It's a funny story. Yeah. So anyway, what are your thoughts on gold and the miners?
So I'll summarize them here. If anybody's really, I did my whole podcast last Sunday was on gold or focused heavily.
And what's the name of the podcast, Brent?
Just so Milkshakes, Markets, and Madness.
Okay.
So it's on YouTube. But essentially what I think we have had is we have had an incredible run in gold for a couple of reasons. One is the debasement trade just in general. And again, that's not only a real thing, but it's also narrative, right?
Yeah.
And as we've talked about, narrative can push things higher. The other thing is
a real thing.
No, but it
keep going, and then we'll talk about that.
Yeah. And then I think it really started a couple of years ago with the sanctioning of Russia and the weaponization of the dollar. I think that had a big part getting it started.
Yep.
At the margin, here's the really interesting thing, and I put some charts up in the thing. At the margins, central banks are buying gold, but they're not buying gold to the extent that many people think. Now, this is not me being bearish on gold. This is actually a reason to think that gold could actually go much higher. So before everybody starts saying, here's Brent, shitting on gold again, that's not what this is. So if you look at the chart that I posted, the actual holdings of gold have not risen that much, if at all, over the last 15 years. Much of the, you'll see these charts that show gold as a percent of overall reserves has
Yeah.
risen a lot, and as treasuries has fallen a lot. A big part of the reason of that chart is those charts are market value.
It's the
And
price.
as the price has gone up in gold and as the prices come down in bonds, they converge.
Yeah.
Right.
Yeah.
And so but the reason that is potentially bullish is because it just shows that it doesn't take that much buying in a tight market to really push a price higher. And when I say a tight market, I mean the overall size of a market compared to the overall potential it could be. So when you look at the gold market, it's like, 1% of overall financial holdings. If you take that even to 1.5%, which is maybe what's happened over the last couple of years, the price doubles. And I think that's what we've seen. But I do think it got way ahead of itself. Now, that's not to say that 4,400 is not a fair price for gold. I can make an argument for gold being much, much higher. But just because I can make that argument doesn't mean it's ever going to happen, right?
Mm-hmm.
And whenever you see a chart going up in an exponential manner, it's only a matter of when it's going to come back down. You cannot, unless you think the entire monetary system is coming down in the next month, which I do not, you have to expect a pullback. And so the point I was making to people is that most people that own gold don't own 1 or 2%. Now, there are people that do own 1 or 2, but most people that own gold own it in a pretty healthy amount, 10, 20, 30, 40% in their portfolio. I mean, I know people that have more than 50% of their portfolio.
Oh, 100%.
Right. And they diversify by buying silver or the miners, right?
Yeah.
And so my point was that, listen, everything you wanted to happen has happened. Gold has doubled. The miners have doubled. Silver's up 60, 70%, whatever the number is. If you were to take 25% off the table, you're still going to have more than you started the year with.
Mm-hmm.
So take that off the table, remove the chance of giving all of those gains back, and then put that money to work back at a lower level. And if that lower level never comes and it just keeps accelerating higher, you still have a lot of exposure to that upside. So I think of gold much differently than most people. I think of gold as a wealth preservation in some kind of a crisis tool. And I actually don't think gold is for the crisis. I think gold is for coming out the other side of the crisis and having some capital intact that didn't get blown up for whatever reason in the crisis. And so if you think of it from that perspective, from a asset protection or an overall wealth protection aspect, you don't need to have all of your wealth in it. You don't need to have 50% of your, having a 20 or 25% allocation is a big allocation in my opinion.
Mm-hmm.
But that's plenty too, because if it really does what you think it's going to do, you're going to be fine. But if people, there a lot of people will say they own gold for insurance reasons, but in reality, they want to get rich. And the reason this is because if you really own gold for protection reasons, and you understand that gold is now at $44,000, you realize that's not a good thing. That is not a good thing for the world, right? Life is not going to be great if gold goes to $10,000.
Yeah.
So in other words, you don't want to cheer gold going to $10,000. Like I've always said, gold could go there, but it's not going to be a great day when it happens. That's not something I necessarily want to see happen.
Yeah,
right.
And not only that, but what people don't realize is, let's just say it goes to 10,000 as a result of inflation. Okay, great. Well, now you got to sell it, and you take a 20% hit on cap gains. So now your purchasing power has not kept up with the rate of inflation. The price of gold has to substantially exceed the rate of inflation in order for it to maintain your purchasing power, unless you think you're going to trade with gold coins. And as I showed people in Argentina, that doesn't work very well.
Yeah. So long story short, I think gold's had a heck of a run. I think it's due for a pullback. I said on the show, I thought it could easily pull back to the 50-day moving average, which is, I think, 3,800. It could easily pull back to there. And if that happened, gold is still up 30% for the year. So it's not like that's a disaster. But again, from 4,400 to 3,600, that's a pretty big move as well.
Yeah. So if we're looking at gold just as a speculative play, because I own it for insurance as well, I own the miners more for a speculative bet. But let's just assume that you're looking at gold just to get rich or just as a play to increase your, just the appreciation.
Yeah.
So how do you, now where we are, it's gone from 44, let's say, down to 4,100. How do you know when to get back in? Like, do you use that 50-day moving average? Do
Yeah,
you look
I would. Yeah.
for a trend to, higher highs, lower lows? Like, how do you do that as a professional money manager?
Well, it's not always easy, right? But
Yeah.
you would look for areas of support.
Okay.
The 50-day moving average, 100-day, 200-day. If it went back to there, that obviously I would much prefer to buy at one of those support levels than to buy right now.
Mm-hmm.
And the funny thing is, I would prefer to what's gold at 4,100, 4,200. Let me just look. It's a 4150. Okay.
Yeah.
So I would rather buy gold at 4,200 if it's sitting at the 50-day moving average than buy it at 4,100, which is lower if it was way above the 50-day moving average.
Yeah.
Right. So you can wait for a correction by price, or you can wait for a correction by time. In other words, you see what I'm saying? But regardless, I would rather wait for the 50-day moving average to catch up, over time than I would buying right now when there's not much support around.
That makes a lot of sense.
Yeah. And then the other thing, this also goes back to the shutdown as well, is the most fascinating chart that has not been updated for me because of the government shutdown is the commitment of traders report on gold. So the commitment, and there's some people that hate the commitment of traders report. They say it has no influence. But what I like about it is it shows what is driving to a certain, it shows one aspect of what is driving the move. So oftentimes in past history, when gold has really made move higher, you can see that it's the speculators that are piling into the futures contracts, pushing the price higher. And the banks, or the commercials is what they're called, they take the other side of that trade and they're short.
Mm-hmm.
Now, since the government shut down, gold went up $300 or $400. I don't know if that is because the speculators plowed in and the commercials got even more short, or it could be that the commercials got scared and covered their shorts, and the commercials covering
because they didn't have the information.
Right. And so, and now nobody has the information because it's just, it hasn't been reported. So, and now there's a lot of other ways to judge gold. And like, that's not the only thing I look at, but that is something that I like to look at. And to me, it's going to be really interesting what it shows when it finally comes out. So this is a long way of saying, I'm glad we already own gold. We've owned it for a long time. I would not want to be buying it right here. If you don't own any gold, then you should probably buy some, even here, right? Again, this is not a price I would like to recommend buying gold. Hopefully you already own some. And I do think the price is due for a pullback. But, to me, the gold is just an asset you have to have regardless of price.
Yeah. Yeah. So looking at it just through the speculative lens, the mistake I made and what I learned is when something...
what'd you do?
Well, so it's going parabolic almost, especially the GDXJ, which is a position I had. And I kept thinking, is now the time to sell? Is now the time to sell? And what I did is I went back to the rules, the Marty Zwag rules that Steve went over in St. Bart's.
Yep.
And I think you're the one that took the picture. Remember, I told you to take a picture of that for me, and you text it to me. So now I've got it up on my computer. So I went back to those rules, and the trend is your friend. And the one that I kept kind of reciting was, he says it in a different way. He says if something changes based on your original analysis, then you should sell. But I kind of do the mirror image of that. And I said, okay, if nothing changes based on your original analysis, then you should not sell. And even though it was going parabolic, I'm like, the reason I own gold, or I own the miners, that reason hasn't changed. So it will change if I start to see retail really pile in. And what I was doing is I was monitoring the spread for the physical dealers, because, you had that parabolic move and the spread was almost at all-time lows. And
Yeah.
and all the dealers that I was talking to were saying that the average Joe was a net seller. So I'm like, this has legs as long as the average Joe's a net seller. But then actually in Rebel Capital's Pro, we've got a couple people in there that have their finger on the pulse. I think one gentleman is a part owner of a gold dealer, and
Yep.
he was telling me that the spreads were starting to increase. And I
Mm.
said, okay, what were the spreads back in like 2011? And he said, about 10%. And I said, okay, what are they now? He said they've gone up in the last 2 weeks to about 5% from maybe, sub 1%. And so
Yeah.
that's when I started to be like, okay, now, now,
Yeah.
now might be a
Yeah.
good time to sell. But I was like, I should wait, and I'm going to wait for the chart, to go here, blah, 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 blah. So then it
One
goes,
thing I would, yeah.
go
So go
ahead.
ahead. I was just
Well,
gonna say that with the whole trend is your friend.
yeah.
I agree with that unless you get into a parabolic trend. Once a trend starts going parabolic, I don't think it's your friend anymore. It's just a matter of time before you get hurt.
Hey guys, everyone knows we're in a huge AI bubble right now, but the question becomes, what do you do about it? How do you protect your wealth and hopefully grow your wealth in these crazy volatile times we're living in? Well, I've got good news for you. October 29th, I'm going to be doing a free webinar training where I'm going to show you step by step the contrarian strategies the pros use to invest during financial bubbles and how they take potential crisis and turn it into opportunity. I'm also going to reveal why the typical approach investors take, which is just buy and hold, buy the dip, or just buy a passive S&P index fund, is the opposite of what you actually want to do, and how that might have worked in the past, but it likely will not work moving forward. Oh, but wait, there is more. The best part about this webinar training is that I'm going to be giving every single person who attends a free bonus. That's right. This bonus is a $500 coupon code for Rebel Capitalist Live. This is the conference, the investment conference I do every single year. It's in Orlando, 2026, end of May. It's going to be absolutely epic. This is an event you don't want to miss. And just by attending that webinar, you're going to get a coupon code that takes the price of a ticket from $599 all the way down to 99 bucks. So if you'd like the cheat code the pros use to invest in financial bubbles, and you'd like this incredible free bonus for Rebel Capitalist Live, you can go ahead and click the link in the description below, and I will see you October 29th. Yeah, so here's the punchline. Here's what
Yep.
I once I sold the position, that big first move down, I'm like, okay, I'm out. So I sold the position. I made a lot of money. It was great. But when right as I sold, I'm like, you know what you should have done, George, is you should have had puts against your position. You should have just had puts, because even if it would have covered the whole loss, you would have lost a lot less. And I'll bet you the put on the GLD or whatever would have been it would have been reasonably priced to cover a
Yep.
lot of your downside. And I thought, okay, that's what Brent would have done. Because I know you
Yep.
talk about that all the time.
That's what we do. We do.
Yeah,
Yeah.
exactly. So that's why
Yep.
your voice was like in the back of my head. So I told myself, the next time I'm in a trade that's going parabolic, I'm gonna buy some downside protection and just buy
Yep.
some puts.
Yep. Well, and the nice thing about that, so not to rub salt in your wounds, but
Oh, please do, please do.
so now you're going to have to pay a tax on the gain that you made, right?
Mhm.
Okay. If you buy puts and you make money, you'll have to pay tax on the making the money on the puts. But if it goes against you, if gold keeps going higher and that put expires worthless, you actually get a taxable loss.
Mhm.
So it's more, to me, it's more tax efficient to buy puts than it is to sell the position. But it kind of depends on what your tax situation is and all that kind of stuff. But that's one of the reasons we do it that way.
Yeah, I'll definitely do that next time. One thing that's working really well for me though is our spread trades. I don't know if that's the technical name for them. I don't know what they're called, but
Just
the
give me
other
an
day,
example.
so the other day I wanted to go short Lennar and CarMax.
Okay.
And I'm like, yeah, but I hate to go into just an outright short position because we don't know if we're in 1999 or in 2000, to your earlier point. And so I'm like, I don't know. So I just had this idea that maybe what I could do is I could take a short position in, let's say, CarMax, and then I could offset it with a long position in the S&P 500. And so my idea there is I'm just kind of
Yep.
playing the spread a little bit like Bitcoin and micro strategy.
Yep.
And I'm just playing that spread. And I thought, okay, if we're in 1999, the S&P 500 is going to rocket higher, but CarMax probably won't go up as much because
Yep.
it is really tied to the real economy, and it's taken a huge hit. The chart looks like shit. The last report was just terrible. And then if the S&P goes down, then CarMax is probably going to go down a lot more.
More. Yeah.
So
Yeah.
what do you think of that? And it's worked out really,
Yeah.
really well.
I don't do a lot of them, but I like those. We're not huge traders. If we see an opportunity, we'll do it. But I do like those trades. The other thing you can do is you can do if you feel like puts are expensive,
Mhm.
you can do a put spread rather than just buying puts.
Yeah, right.
So in other words, you buy I don't know, if you're GLD, you buy the 375 put and you sell the 365 put or something,
Yeah.
right? And you cut the cost of the premium in half or whatever it is.
Yeah.
But I like doing short-term tactical trades. So I'm not doing those all the time, but I actually like that trade that you just mentioned because, like you said, if things get bad, those junk companies are going to do worse than the S&P 500.
Yeah.
Um, the flip side, though, is if for whatever reason, that individual company has some positive catalyst,
Mhm.
it could really rocket higher while the S&P 500 doesn't. So
Yeah.
it's not foolproof, I guess is my point.
No,
I
it's
tend
not.
to agree with what you're saying, but whenever you trade a single stock, you are open to both single stock downside and single stock upside.
Mhm.
So think about, I mean, this kind of gets back into the whole Mag 7 or AI narrative, but this whole infinite money loop where Oracle gives 100 billion to AI and AI gives 100 billion to Nvidia and Nvidia gives 100 billion to Oracle, right? And Broadcom announced the same thing twice a month apart and went up $100 each time. I mean, I'm
Yeah.
exaggerating,
Yeah.
but that's what you open yourself up to. Some news announcement that just shoots the individual stock higher.
Yeah.
For
Hopefully
an
I've got
example, so something like CarMax, right? Let's just pretend, and I'm not saying this is going to happen. Some PE firm likes it now that it's beaten up, and they come out over the weekend and they say we're going to do a leveraged buyout on CarMax. Now, I don't think any PE firm is going to do that, but if they did, stock could open up 20, 30%, the
right.
next day.
Okay, yeah,
Yeah.
I'm gonna have to think about that. I'm gonna have to figure out a way to try to hedge that out. That happened a little bit because the other day GM reported really good earnings, and CarMax went up about, I think it was like 4% or so on the day. And I thought, well, this is just GM, and that's just front running
Yeah.
tariffs. I mean, that's looking in the rearview mirror. So I added to the position, and it worked well because it went straight down from there,
Yeah.
just like I figured it would. But yeah, I'm gonna have to figure out a way to hedge against that possibility of some private equity
The
firm
other
coming
thing,
in,
if
putting in a bid
also
on it.
if you're going to do a trade like that, you also need to me at least, you have to monitor uh, the news fairly well for what the authority. So let's say you get into a position. Let's say you had that position on in March, right?
Mhm.
And then we had the big sell off, and let's say the S&P 500 went down a lot, but CarMax went down even more. When things start getting bad like that, it increases the likelihood that Trump's going to come out and say something, that Bessent's going to say something, that Powell's going to institute some new policy, an emergency rate cut or whatever. And then you get in the dash for trash scenario where the most shorted names and the things that have been beaten up the most and the worst companies move more than the S&P 500
Right.
just because they've been so oversold. So again, it's not that those trades don't work, but it's just that they're not risk free.
Yeah, for sure. So I've got a hedge against private equity and Trump tweeting. I think the latter there is much more difficult.
Speaking of which, we haven't spoke since Trump's comments on Colombia.
Oh, what I know he's in a big pissing match with Petro.
Well, he says your president is a drug dealer and all that kind of stuff, and
Trump's right. What's funny about that is both of them are just total blowhards.
Totally.
And
totally.
but the ridiculing that Petro does with Trump, I think, is correct. What he's describing Trump and how Trump describes Petro is probably pretty correct as well.
Yeah.
No, I'm not a big. I hate Petro, but I'm not a real big fan of what Trump has been doing lately with taking positions like equity positions in all these companies, and now they're going to get into quantum computing. It's just
So my take on that is I in a perfect world I totally agree with you. I don't like it when governments get involved in private business, but I'm also a realist, and I think this is just getting started. I think not only is that going to continue, but it's probably going to ramp up.
That's my concern.
No, I know.
My concern.
Well, but
once you get on this slippery slope, it's like, oh well, and once you use that excuse, well, it's a security risk. Okay, you can make that argument for anything. I mean, you can make that argument for oil. You can make that argument for copper. You can make that argument for nickel. And where
they will.
Where exactly?
Well, exactly. But this is okay. So this is where you have to, if we're just talking investing, right? Take out the moral aspect, take out the political aspect, take out how we want the world to be. If you're just trying to make money, that stuff, I think in the long run is really bad for markets because it makes it less efficient, the misallocation of capital. You're depriving good companies of getting funding when political allies get funding, all that stuff that we know. But it doesn't mean that it can't turbocharge markets higher in the short term. And I think,
no, I'm not talking about it.
No, I know, but I'm just for listeners who are saying, oh, that's really bad because it's going to lead to inefficiencies. Yes, fair enough, but that doesn't mean imminent, right? Again, you get back to the inevitable and imminent. This will inevitably end bad, but that doesn't mean it's going to imminently cause markets to go down.
Yeah. And it might not end bad for the share price. It might just
exactly.
The economy. It might end bad for society as a whole. Yeah. I mean, that's really what I'm talking about.
Yeah.
When I really don't like the government getting. I mean, I'm all about free market capitalism, and that has nothing to do with the free market whatsoever.
Yeah.
And I get the argument that we have to, it's a national security risk, or we have to compete with China. But at the end of the day, I just don't think the trade-offs make sense at all. I actually put out a tweet that I thought was rather interesting, but I said, I don't know that I've seen anyone do like a proper, thorough cost-benefit analysis for the government getting involved with these companies. So as an example, what's the worst case scenario with China? Like, what's the word? People always say, well, we have to stop China. We have to stop China. Okay, but stop them from doing what? Okay, ripping off our trademarks or ripping off our technology. We have to stop them from spying on us. Okay, yeah, I think those are very valid arguments. We have to stop them from producing stuff too cheap, if you want to use that argument, for stealing our workers or our manufacturing jobs. Okay, we have to stop them from invading us. Probably not.
Yeah.
We have to stop them from nuking us. Probably not. So at a certain line, you say, okay, the costs don't go infinite as far as, not stopping them. So then you look at, okay, what are the costs to us? And then it's higher, maybe higher inflation, maybe this, maybe this, maybe this, maybe this. And when you start to do that, you start to realize that, okay, maybe, China, or stopping China, has a price that's actually too high. And maybe, just maybe, the cure is worse than the disease. And I don't think people have really thought about things in those terms, because at the end of the day, this is a tribal issue. I mean, it really is. I mean, at the end of the day, is all about politics and whether your
I was say
team.
this is not about economics anymore. This is about politics now, and it's about power, and it's about
Yeah, and if you don't believe me, Brent, that look, if you have a 100% tariff on China or a 500% tariff, you might as well have an infinity tariff.
Sure. Yeah.
Because we're talking about profit margins that are like 10%. So
right.
It is, just by the numbers they're using that this is all just kabuki theater.
Yeah. But I will say, so listen, I totally agree with you. But again, when I look at portfolios and try to consider, as a fiduciary of other people's capital who may agree with me politically, may not agree with me politically, who may see the world in an economic perspective the way I do, or they may not. But for whatever reason, they've entrusted me with their capital. I need to try to grow it, right? Mm-hmm. And while I don't necessarily like the government involvement in markets, as I mentioned earlier, I think it's going to happen in a big way. We're actually going to be investing in a fund where we're basically partners with the government, because the government, as part of the big beautiful, I don't know if people know this, but as part of the big beautiful bill, I might not get these numbers exactly right. I think they allocated $200 billion to the Department of War or the Department of Defense, whatever you want to call them, and they have a group that I think is called the Office of Strategic Capital, where they're giving them, I think, $200 billion. And that $200 billion is then going to be offered to funds, asset managers, to go out and invest that money in critical technology and mineral companies that help the United States become, quote unquote, self-sufficient and no longer reliant on China. And that money will have a real impact on share prices, right? And so now, and in the short term, it may even help the US. Now, long term, of course, for all the reasons you just perfectly described, I don't think it's a great deal. But over the next 2 or 3 years, 4 years, I mean, I really do think that this is like the 21st century Manhattan Project. I think that's how the government sees it. They see it as a self-deterministic or an existential issue, becoming self-sufficient, and they're going to spend whatever money they need to do and push whatever regulation they need to push through Congress to get it done. And that will, whether we like it or not, that will affect markets.
Yeah, for sure. Yeah. For sure. I think also people need to realize that the reason China produces or has a monopoly on so many of these things is because we don't want to produce it here. And I'm not saying that's a bad or a good idea.
No, that's exactly right.
That's the reality of the situation. It's not necessarily that China has manipulated the rare earths market. It's that China has been totally okay with destroying the earth and just creating all this toxic sludge. So what you're saying there, by us being self-sufficient, is you want us to go ahead and produce the toxic sludge. And I'm not saying that's a good or a bad idea, but that's the reality of the situation. So, I think throwing money at it, now we're going back to whether or not this will work. Throwing money at it, I totally understand that, but you're also going to have to dramatically reduce regulations around environmental issues if you want to be, quote unquote, self-sufficient around things like rare earths, because you can't have your cake and eat it too. We can't be Greta Thunberg or whatever her name is and also be self-sufficient. It doesn't work that way. Unfortunately, the shit we need to build the stuff we want to build requires digging a lot of holes in the ground. And often this is where you don't want them to dig holes, and the byproduct of that is often very, very nasty.
So there's first of all, I totally agree with you. And I would just point out there's two sides of this, right? Because essentially what you're talking about is exactly what Germany has done. Germany has said, we don't want to dig those holes. We don't want that stuff here. Yeah. And as a result, their industry is leaving Germany, and they're hollowing out, which was once was the engine of Europe, right? Mm-hmm. And so and they are seeing, so to me there has to be some kind of a happy medium. Like, we're not going to be able to not mine things. We're not going to be able, we're still going to need coal, right? Some of this energy is going to be dirty unless we want to go back to living like we did in the 1700s, which might be interesting for a few weeks, but then you're going to get pretty tired of it, right? And I think what's his name? Konstantin Kisin, is that the guy, the Russian guy that lives in London?
I
He's
don't know.
a political commentator. He gave a great speech at I don't know, like the Oxford Union Club or something. He was doing the debate or something a couple of years ago, and he was talking about how the West, or the G10, or however you want to describe it, has gone to these some of these countries and said, you know, you don't, we need to institute these green policies, and we can't pollute the earth, and da 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 da. And he said, you can't tell any mother or father in the world who knows if they push a button and all of a sudden the lifestyle and the well-being of their child,
That's right,
dramatically increases, regardless of what it does to somebody else on the other side of the planet.
or what it does to
That
a
you
few
don't know.
whales, or
What it does to a few whales.
the ocean.
Every mother and father in the world will push that button.
Yep.
Right. And so I don't know if that's a good example or not, but that's sort of where, like, we have to kind of decide, do we want to live in a modern world? Do we not? Do we want to be self-sufficient? Do we not? Are we going to push that button, or are we not? Now, I would say we were way too lax for way too long, and at least not pushing the button here in the United States. And I think Germany has been way too lax, not pushing the button in Germany. And I think both Germany and the U.S. are feeling the side effects of that now. Germany more so than the U.S. And I think we're probably headed back into a time period where we're going to at least admit that we're going to start pushing that button a little bit more. Even though we might not like it, we're still going to push the button.
Yeah.
And
to be clear, I think that's a good thing. I just want to make sure that people are very honest and realistic about the trade-offs involved, because usually they're not. Usually they just look at the benefits, and they completely and totally ignore the costs. And also, too, let's remember that even if we do get rid of these environmental regulations that would prevent us from creating the toxic sludge or digging the holes, your labor costs are still going to be way higher, way higher. And therefore, if rare earths are such an important input to so many things, the price of those things are likely going to go up. If you do the same thing with copper and with oil, the price is going to go up. And therefore, you're not just pushing a button for the standard of living, the observable standard of living. You're also pushing a button for the observable prices going up and up and up, a lot more than your paycheck, which will further result in the deterioration of the standard of living.
Yeah. You know what God, we're kind of veering off of investments here, but you know what I think about a lot is that my son Moses, he's 17 now, and he, we've been lucky to take him on some pretty nice trips. We came down and saw you, and he loves doing that. And I'm thinking, you and I, we kind of grew up in the golden age of travel, where you could pretty much go anywhere in the world you wanted. If you had the money to do it, you could go to China, you could go to Russia, you could go to Mongolia. If you worked hard and had some savings, you could get on a plane and go just about anywhere.
Yeah. Without an anal cavity search from TSA.
Without the cavity search, unless you were going to a war zone, right? You didn't have, without too much danger. My fear is that, because he really wants to do more of that. And I don't know if it will be as easy to send your kid on an, 6-week Asian backpacking tour as it was 10 years ago. Right. I don't know if it will be as easy to think about sending them to Europe for the summer and letting them, jump on trains and go from a safety issue, not only from a safety issue, but from a freedom of movement issue. My guess is that it won't be as easy to do that kind of stuff in the years ahead. And it partly relates back to what we're talking about as countries try to become more self-sufficient and more self-reliant. The flow of not only capital, but people probably falls a little bit. Anyway, that's kind of been on my mind lately.
Yeah, especially the U.S. passport.
Yeah.
I mean, that has, for our life, at least as long as I can remember, has been one of the best passports for traveling the world and just going kind of wherever you want. But those days may be over. And I know I think recently, the EU told us that we've got to have a visa now. I think, don't quote me on that one,
Oh, is
but I'm
that?
like
I haven't heard that.
90% sure.
Wow.
Yeah,
I hadn't
yeah.
heard that.
And we always get into a tit for tat with Brazil and all these other
Yeah.
countries. And what they always do is we say, okay, well, from now on, we're not going to allow any Brazilians into the United States without a visa. And then the very next day, Brazil just does the exact same thing. Like
Yeah.
there's no real security risk there. It's
Yeah.
just just kind of an ego thing. And if you're doing it,
Sure.
I'm going to do it. And to your point, that's probably going to happen a lot more in the future, unfortunately, for the younger generations.
Seems that way.
What do you think about the dollar, man? I mean, obviously, I want to talk to you about that. And as you know, that's what most people need to know is the dollar, not just versus goods and services in the United States, but more so against other currencies, is probably the most important macro issue due to the way the monetary system is set up. So I think that's actually really interesting. So rates have gone down, if I'm not mistaken, very substantially. And then the dollar has gone up, hasn't it? Isn't it
Well,
right
yeah,
around
and
99?
that's right. And I think you have to remember, like, markets move on anticipation, right? Or or on expectations of moves. And the interesting thing for me is, despite all the talk, all the death of the dollar, they're really going to kill it this time, is the dollar's higher now than it was in April. I mean, it went sideways for 5 or 6 months, but it's now higher than it was in April.
We're at 99, aren't we? Roughly?
Yeah, roughly 90. Yeah. It's kind of been flirting around there. I think it got as low as 96 at one point or something.
Yeah.
You know, I expect the Fed to cut next week, but I don't expect the dollar to go down a lot. And here's the thing is, I think people often misinterpret my views because of how hard I pound the table on the dollar not losing global reserve status or not going away. That doesn't mean that the dollar can't go to 95 or 92 or 89 or whatever it is.
Sure.
My point has always been is that if that happens, I don't worry about that, because that's the system is continuing to work as it always has. Assets are probably going up and to the right in that scenario.
Yeah.
And
global blows people's mind. We don't have time to get into it now.
Yeah.
But if the dollar does go down to 80, that's most likely a result of the what do you want to call it? Dollarization.
That's the dollarization.
It's not a result of de-dollarization. It's a result of more people and
exactly.
more demand for dollars, not less.
But I think the market has kind of priced in the dollar moving lower. It's the dollar moving higher that you have to worry about.
Yeah,
right. And that's the point I would make. We just put out a big report on US dollar stable coins, and I'm the first to hold up my hand and say, when these first came out, whatever it was, I think the first one was issued like 10 years ago, and then they started to proliferate more 2 or 3, 4 years ago. I didn't think they were that big a deal, but I think now that they are a huge deal. I think they're a very big deal. And when the time comes that the United States, like, officially under some form of sanctions them or blesses them in some more official way and starts using them for U.S. official payments or receipts, I think it has the potential to turbocharge the world using dollars even more than it has now. And this stablecoin report we put out talks about how, it's a way for individuals around the world and institutions around the world to escape their local currency, capital controls. And at the end of the day, a domestic currency is a form of control for that. And it's a tool that government uses to maintain sovereignty and to maintain order, their political power. And once that starts to get lost, that country loses sovereignty. And that is why whenever you see a country go through a currency crisis, the government usually falls fairly shortly after that. Because if you have a jurisdiction over which you are beholden to some other form of money, then you are not truly sovereign. And I think that's what this US dollar stablecoin proliferation has the potential to do. So it's going to be really interesting to see how. For me, it's fascinating. It's going to be really interesting to see how this kind of plays out over the next 2 or 3 or 4 years. But long story short, going back to your question on the dollar, I think the risk is that the dollar goes higher, not lower. I think these rate cuts are already largely priced in. Exceeding the expectations, I think, is going to be difficult. It's not impossible. But I don't worry about the dollar going lower, because that just means things are still functioning as they should be. I worry about the dollar going higher and what that can do to portfolios.
Yeah. And I'm sure people are saying, George, how on earth are you saying that if we have dollarization, the opposite of de-dollarization, that may result in the DXY going down? And because people see it as, they're just dumping dollars, there's less demand. So the point there, guys, real quick, is just when you have an increased demand for dollars, you have more dollars being lent into existence, and you have most likely you have a higher velocity of the dollars that currently exist. And with de-dollarization, it's the opposite. So with dollarization, and we saw this from 2000 to say 2011, and this is a result of all the emerging markets. There's demand for dollars because they had to buy these commodities because they wanted to grow and grow very, very quickly. And so you had increased demand for dollars and increased creation of dollars by the global banking system, and an increase of velocity of those dollars, which brings the value of the dollar relative to other currencies actually down, not up. And it was a process of more demand for dollars, not less. But I wanted to give you a couple anecdotal pieces of evidence there, Brent. When I did the Argentina trip, and just for those who aren't familiar, I tried to drive across Argentina. I did drive across Argentina using nothing but gold, silver, and Bitcoin. And what I was trying to do is I was trying to sell these assets for the local currency, so then I could go ahead and buy the hotel room or buy food or gas or whatever. And it was very difficult to sell Bitcoin. Very, very difficult to sell Bitcoin for the depreciating peso, which was at the time was depreciating by 20% a month. But what everyone wanted was Tether. Everyone that was receptive to like crypto or Bitcoin, or the kind of the younger generation, they were like, do you have Tether? Do you have Tether? Because you have Tether, we'll go ahead and do that.
And you got US dollars, right?
Yeah. And so they were totally, if they were open to using that type of technology, the very first thing they asked me was, well, we're not really interested in Bitcoin, but do you have Tether? Another thing is Angie and Joaquin, who you know well, my husband and wife team down here that does most of my real estate. Angie right now manages probably 150 doors, 150 Airbnbs down here and in Cartagena. And she was telling me the other day that now a good percentage, maybe 5 to 10% of her transactions, people are paying with Tether or USDC.
Yep. That's a perfect example of local economies outside the U.S. jurisdiction becoming more and more dollarized.
Yeah, for sure. Hey, how can people find out about the podcast, and how can people get that report?
Yeah, so for the report, if you go to research.santiagocapital.com, we have a special going on now. So the stablecoin report is a pro level report. We have two levels. We have a premium level, which is $399 a year, and we have a pro level, which is $2,400 a year. The stablecoin presentation is a pro level report, but for the next 2 weeks, we have a special where if you sign up for the premium level, which is the lower price level, you do get the pro level stablecoin report. So go to research.santiagocapital.com. For the show that we do every week, if you go to YouTube and type in Milkshakes, Markets, and Madness, we put that out every Sunday. And then you can also go to santiagocapital.com and you can kind of find all of this stuff from that site as well.
Yeah, and that's your Twitter handle too, right?
Twitter is it's actually if you search for Santiago Capital and look for a white seashell, that's me. The actual handle is at Santiago AU Fund. But I'm pretty active on social media, so any of those methods you should find me.
Okay, buddy. Thanks for coming on, man.
Thanks for having me. Talk to you soon.